Yeah, good morning everyone. This is an early morning rant. I've opened up my windows here so you can probably hear either the chirping or the planes flying around from time to time. But this rant really starting off on something that showed up on Twitter. Somebody was suggesting, why don't you start an AMC, given the way your views are probably going, or maybe that's how I read it. And what I understand is essentially the indication is that why don't really you help people, create wealth, and in terms of doing it as a service. Now, given how old I'm getting, whether I look like it or not, it's been a long journey, and I've actually tried a lot of that, and the end result is that I think most people, in terms of what they really want to achieve, whether it's a long-term wealth creation goal or whether, what are they really doing in the market? First of all, that is not clear, is what I've found over time. And a lot of people really need to help themselves because it's really not possible to help people build wealth unless they have the right mindset. It doesn't matter. And my reply, which he didn't take very, very well, was that if you're really thinking about creating wealth and you start comparing immediately with wealthy individuals, and so you're talking about making an EMC and helping people create wealth. But what is wealth really, and who are the most wealthy people you compare with when you say you should create wealth? And either you go to the top end and you start comparing with Warren Buffett, or there is that middle category somewhere between Warren Buffett and everybody who's made maybe more than 50 crores or 100 crores in the market. And if you're looking at that entire category, you're possibly mostly looking at individual investors. You're really not looking at people who put money in a mutual fund and after 20 years became multi-millionaires. I haven't heard a story like that yet. So, so the whole point being that you need to think about why that is, and there are serious advantages that you have as an individual investor that you may or may not have, based on how many of these funds are structured, because they're not really concentrated investments. And that some of the big money that got made by individual investors, either by investing in Infosys by chance, maybe in 94 or 96, and the stock goes up 100 times, that doesn't happen unless you own it personally. If you own it through a fund, it's possibly not more than 1% of the fund. And so the impact on your long-term growth may not be so much unless you held maybe 10% in that particular stock, or 5% maybe. I would say 10, but then even if 5 would be a starting point. And also as it grows along, if you're in a type of mutual fund where, there are limitations, you cannot own too much of a stock in your portfolio. The moment its weightage goes up more than 10%, they're possibly going to sell some of it and reduce the weightage. So that's how most models really work. And how are you going to really achieve that, end result which you would have had if you possibly held the best performer stock in your portfolio for the long term? Because if something is performing well, why should you be getting out of it and reducing weightage? Instead, you should be either increasing weightage if you have a continuous supply of funds, or that's the one thing which you should possibly not touch at all. So that's very, very simple and logical and can be very easily be done at an individual level. Now, this is just one part of the story. The other part is that behavioral finance problems spread across. It's an entire subject of study now. There are so many biases that force people to take wrong decisions at the wrong time. Something I experienced as a PMS manager for almost a decade is, when people should be investing in the fund, which is typically when the fund is not doing well, because that's when you have a drawdown. And it was, of course, a long short fund, which means we could go either way, except that we were not leveraging. And then when the best opportunities came, when you were trending move up or down, then people are not there. And most funds get sold, if you look at it, historically, when the market conditions are good. So it's at the peak of the market. So people always invest more at the peak and they don't invest at the bottom. So that's just typical behavior. And in a long short fund, it's even more typical because you expect, more people to, come in at the wrong time, because in a long short situation, you could actually be shorting the market on the way down and, buying the dip, but people will still withdraw money when the market starts falling, when exactly you're going to give the highest return in a long short kind of structure. So there are various reasons why people will behave against the odds, and as much as they feel that they're betting on your capabilities, they're really just judging by the day-to-day movement of their NAV. For the last 1 year, I've been trying experimentally working with one of my cousins and helping him invest. And when you're investing long term and you're a young person, which means it's like an SIP, because every month you get some income, you have some expenses, and then you have a leftover capital that you're investing in the market. So if you invest the same amount of money in the market every month, and the market's been going up for the last 1 year, then your returns cannot really be exponential. I found that end of the year, my returns will be far higher than what you would do, because I would have done a lump sum at the start of 2020, and you would be putting in something every month. And even though the stocks and sectors are the same value wave investments that I like, his performance significantly differs because the buying is happening at a different level and higher up. And so every time the market falls 1%, there's an SMS saying, is everything okay? And imagine the same thing when you're actually a fund manager, is that people start withdrawing money. They get scared, and especially if you have a slight drawdown, even though you may have sold it saying, see, we can have a 30% drawdown and you can have a 100% return based on the historical back test. But if you get a 30% drawdown, half the people start running away. Or else they'll start blaming you for, being, for over trading, not having a proper strategy, not implementing certain things, when all you're doing is following a model that you predefined right at the beginning. So, in short, what I'm trying to say is there are n number of reasons why, working, expecting that somebody else will solve your problems may not exactly work. And if you're really looking at long-term wealth creation, you need to do an inside job. You really need to look inside how you're trading, how you're investing, how you're allocating capital, and what type of risk you're taking. If that's your real goal, it's something that has to be done at an individual level, through a lot of insightfulness, some long-term thinking, taking in ideas from various people, and it's available. Various people. The moment you start getting in touch with people who are in the investment world or financial world, or you're a broker, you'll start getting ideas. The question really is not whether you can get ideas and verify them in a very simple way. The question is whether you will execute it properly. And if you don't execute it properly yourself, you're expecting somebody else to execute it in a structure which is legally driven to work in a way that you don't complain. Because you see, most structures and regulation, like whatever SEBI regulation comes in around PMSs, advisors, investment advisors, and so on, is always based on the idea that, what are customers feeling? So if customers start complaining, oh, this is how different this fund manager is doing like this, and I'm not happy, there'll be new regulation against it. A lot of people complain against something else, there'll be new regulation against it. And so there'll be enough regulation to make sure that you can't do what you think is best for everyone's interest. And moment you do think you want that level of freedom, you'll end up with an AIF where the entry level is going to be a couple of crores before you even get started. And or else it will have to be a family office. And so those are anyway structures for wealthy people. And so very simple insight is, well, if you're wealthy enough and you understand risk, then fine, you can take this structure which applies only to wealthy people, where the fund manager can do much more in his own way. But how does that really go out in helping individuals and people who are trying to get started? So that's the primary reason why I, after having done whatever I've done before, do not really take an interest in getting, into any of these businesses which are regulated, whether it's advisory, portfolio management, any kind of asset management business. I've decided to go against because I'd rather do my own thing myself. And what I urge people to do with the Indiacharts platform is learn to do it yourself, figure it out. There's a lot of information, I think, analytically, which I'm sharing, which is the analysis that goes beyond my investment and thought process. That's the whole way this blog works, is that I share what I'm doing, what I'm thinking, how I'm taking decisions. I'm not telling anybody to do anything in any way, but you can use that information to improve your knowledge and understanding of markets and do it yourself. I think that's the only way long-term wealth creation happens. And then you look out and see that all the people who've really gotten there have done that on their individual investment in portfolios, or by investing in a business, or figuring it out in one way or the other. It's never been through investing in an AMC business. I mean, the only time you go there is once you've created wealth, and then now you don't want to take those high risks. Okay, you want that only 20%, 30% kind of setup. You don't want to expose yourself now in a big way because you've done that before, you've achieved your success, and now you want to actually reduce your risk. And then you go to an asset manager who will, diversify, spread it across assets, and give you that lower risk compounding return from there on. So that's when a lot of people actually choose these fund structures, not necessarily just mutual funds, but even the advanced structures. A lot of people do choose. It's not that they don't, but they do it once they've already, gotten there. And so, if you're someone who's looking at the, path from where you are to getting there, then I think you need to do a lot of work on your own. Look inside your house, get it in order, learn a lot. Learn about behavioral finance, because after we teach the science of markets, how to analyze, how to buy, how to sell, the biggest hindrance, if I teach you everything I know, the biggest hindrance I've seen to finally getting there is something up here, which is what behavioral finance is, which is managing your mind, managing your ego, handling various biases that have built over time based on how you've grown up or how the school system have taught you. And you start believing that you're supposed to be right, but the market is a probability game and you can't be right every time. And you have to learn to handle that risk of not being right all the time. But of course, you need a methodology that works 70% of the time. And then you learn how to handle that 30% when it doesn't work out your way. And if you do that, so if you get over the behavioral finance aspect, then you're set on course to achieving those long-term goals. So this is my short morning message for the 8th of September 2021. Thank you.